On myself first. My name is Kiernan. I'm the founder and CEO of Greengage. We call ourselves a digital finance pioneer. My own background is as a banker. So I built a bank within Credit Suisse in the UK. So I moved to the UK in 2010. We then sold the office that I built to a division of Mubadala, which is one of the Abu Dhabi sovereign wealth funds. And we were merged into a bank called Falcon, which was the first bank in the world to offer crypto to its clients. In 2017, we opened up the buying and trading of Bitcoin on platform with custody and trading solutions. I was the London COO of that business, got very excited about crypto, blockchain, and how it could transform the plumbing of banking, and set up Greengage with a view initially to getting a full bank license here in the UK that was crypto friendly. Let's just say I've done something completely different, but I'll explain a bit of the story as to how that happened. The name Greengage itself maybe isn't that transparent. Why green? Why gauge? It's a nice plum. In case of you, those of you who don't know it, green stands for growth and money, and gauge stands for gauge as in mortgage. So mortgage is the collateral. And what we're doing essentially is revolutionizing the world of private credit. I'll explain what that is and why blockchain and tokenization is so pivotal to that revolution. First off, just a very brief introduction as to kind of what is banking. And forgive me again for being so kind of basic in this, but it's essentially two things. Liquidity, so the making of moving of money around, payments, transactional banking, and also the pricing of risk. And this is then how do you get credit moving from a bank's balance sheet? How do you get different loans originated, and how do you make those happen with the two pieces connected? So for those of you that haven't heard of fractional reserve lending, the idea of banking is almost creating money out of thin air. If you have a deposit account on the payment side, you can leverage that up on the bank's internal balance sheet and lend out more than the money you have yourself. So it's a very interesting world that we've created in the West of what banking is. One of the issues that we've seen is that this mix of say liquidity and pricing of risk has started to get some issues, particularly for SMEs or small and medium-sized businesses. In the UK, there's a persistent funding gap for SMEs, which is a real growth issue for the economy. SMEs are the driver or the engine room, if you will, for employment and innovation. And the Bank of England's highlighted that there's a 22 billion sterling funding gap for SMEs. We have an office in Abu Dhabi, and we've also noticed there's an even bigger issue for SME funding in the GCC or the Gulf more broadly. And the World Bank says that there's a $250 billion gap. So these are big issues. And one of the reasons banks are maybe lending less to SMEs is that it's difficult. SMEs are smaller, they get harder to price for the risk. The underwriting function is understanding the inherent risks in SMEs, and they have other options for lending. They can do mortgages, or they can lend to big companies, and these are relatively low risks on the balance sheet. So SMEs have suffered. The other big theme is what we call debanking, or the closure of bank accounts. And obviously this has been popularized by Nigel Farage last year, very famously. But the bigger issue, which is the unsung problem, is over 140,000 UK businesses had their accounts closed last year. And this is a real problem also for growth. If you can't get access to that basic liquidity issue with banking, the movement of money, you can't run a business. And a lot of these businesses are not bad businesses. They're maybe just one step away from the main train tracks. In the crypto space, this is a particular problem. If you're in the crypto industry and you open up a bank account, you almost have to count your days until the bank might close you if they don't like the way you behave. And you won't necessarily find out the reasons. For better or worse, this is the problem that Greengage is addressing, and we're doing this in a different way. So I'll explain how that works. Maybe one more background story is the rise of private credit. So as banks are lending less, we see increasing debt or credit coming from non-bank lenders. And for those of you who aren't aware, what this is, it's a $2 trillion asset class now. So it's been one of the great growth stories of asset classes globally, driven by credit funds primarily, but also non-bank lenders, including um, infrastructure debt providers. And you see that this growth has been kicking off almost in parallel as banks have pulled back from lending. There's this new world, which is more expensive because there's no beauty of fractional reserve lending to kind of lower the cost of funding. A lot of the funding for private credit comes from ultimately, and interestingly, insurance companies. So we think of long tail risks with insurance or pension funds, for example. These monies are where real risk is now taking place outside of the banking system. So why do I go into this background? What Greengage is trying to do is essentially flip the idea of a bank and make the world our balance sheet. So we see that there's a real issue for SMEs to access banks. And so what we're doing is leaning into that problem by sourcing a technology-first solution, but with people to open accounts and source lending for our clients. And I'll explain how we do that. The tied agent banking, as I call it, is what the old world does. So if you have a bank, and say one of the high street banks, Barclays, HSBC, the banks, by tied agent, I mean that they're selling their own products and services nearly exclusively to you as a client. So the direction of travel is when you give your money to a bank, you're not giving, you're not storing that in safekeeping, you're actually loaning your money to a bank in the form of a deposit, and then they will return that to you with interest for the benefit of you taking the risk, the counterparty risk of giving that money to the bank. And what we're doing is flipping that entirely. So we see a client as the source of data and relationships. And we instead of pitching the client, the direction of travel is from them to us. Our tech stack places their accounts with the panel of account providers, and these are what we call banking as a service providers. This is something that, if people aren't aware of, is fairly commonplace. So Revolut, for example, started by building its account platform on a third-party regulated provider. So we can use third parties' licenses and regulatory permissions to give us that plumbing or infrastructure to open up an account. Greengage, interestingly itself, doesn't need to be regulated to provide the service. We can use partners' regulatory permissions in their own right to do this. And what we have then is essentially a swim lane. So if our client comes to us in a certain industry or sector, our job is to find a home for that client, or maybe homes if they'd like multiple accounts. And we act as a funnel to help them get the solutions that they need. Occasionally we plug in the API or the connectivity of that account provider directly to our own app. And other times, if we can't have that integration, maybe the account is a bit special, we'll make an introduction to find a home for that client. The bit I'm really going to drill in, though, is the credit piece, which I think is where we're doing some pretty cool stuff on the tokenization and use of blockchain. And we take a very similar approach here. So instead of us being a bank, where we're only going to use our own balance sheet to give you loans, occasionally banks will have loans that they think are good credit risk, but they struggle to get enough balance sheet of their own, so if they're only thinking of having a certain pie that they can use for lending. What we do is also change that. So we think of that credit world of private credit, and we can access, again, swim lanes for different types of credit. So we can have credit funds, family offices. We can plug into DeFi. This is relatively new, and I'll kind of explain how that works for traditional business to access the digital world. But also tokenization. So we're kind of flipping this. And my own journey to come to this business model was one of pain. I have to admit, initially I tried getting a full banking license here in the UK. And for the first 3 years, it was kind of bank of Dave. So I was pushing to get Greengage its own traditional banking model, but a crypto-friendly approach, just as what I've done historically in my own past. And this was tough. We looked at banks in Switzerland and the US as proxies. We saw that what they were doing was taking a very sophisticated client base. If they say they were crypto-friendly, they were taking deposits from clients that were digitally savvy and could move money at the press of a button, and then lending that on in the fractional reserve model. So there was a mismatch in perhaps the duration of the deposit base with the risk of having a longer term loan. And then, thankfully, in a way I'm grateful, our business model prevented us from getting a bankruptcy, in that a lot of the banks that had taken that approach, particularly in the US, have gone bust. So names you might be familiar with, Silicon Valley Bank, Signature, Silvergate. These were a few of the crypto-friendly banks in the US. They, for various reasons, had an issue when there was a whiff of risk in their client base. People pulled deposits from their balance sheet, and they then had to hold time on some lending, and they had then not enough capital to meet the regulatory requirements. So what we're doing is, again, it's very much, and I'm using the word Web3 here. We're more Web 2.5 in a way, but we're not taking deposits on our own books. We're acting as a swim lane with a very thin tech stack to place those. So that's a long explanation, but I'd like to kind of maybe just explain how that in practice works for us. And in short, we have opened multiple accounts with different banking as a service providers. We've now processed hundreds of millions of payments for our clients, in the sense that we're using third-party, again, banking as a service partners to place these accounts. And on the flip side, for credit, we've now done over 300 million of placement. And here what we do is originate either borrowers or lenders and connect dots. So we earn our fees if we successfully place those clients that are looking for loans with a balance sheet or a partner that has the other side of that, but the lender. The flagship product we've been focused on has been crypto-backed lending, so using Bitcoin collateral to release the fiat cash. And we've focused, again, purely in the B2B space. So we're not touching retail clients, meaning we do not need to be regulated. So interestingly, in the UK, B2B lending is outside of the regulatory perimeter. I had someone joke that we were a shadow bank recently, which I kind of took on the chin, but we are essentially delivering a banking style service very clearly without being a bank. The bit that I find very interesting is that middle segment. So how do we get the data and the relationships that we have for our accounts or lending clients, and how do we cross-fertilize? So how do we get, if we have, say, a client who has an account with us, how do we understand potentially if they might need a loan that we could place with one of our partners? We're also keen to work with partners to find access to origination and lending. The next step for us as part of our credit platform is to work in a very interesting way to tokenize private credit. And here we were the first globally to launch a digital debt transaction live with Coinbase. And we did that in the UAE, in Abu Dhabi, where we have a new office, just in November. So it's pretty hard to press. And why did we do this? Kind of what's the point of tokenization for private credit, and why is this so interesting? We've seen the likes of Apollo, which is a huge credit fund, just launched their first digital debt transaction a couple of weeks ago. And I think there's two bits to the story as to why this private credit space, this 2 trillion plus asset class, is starting to look at tokenization. And for us, it's not the only swim lane, as I refer to it, for a source of credit, but it's a very interesting one to cut costs. And that for us is the primary driver. But we're agnostic as a house. If it suits our clients to do traditional lending more, we'll take them down that route. If they're open and able to consider maybe a new novel technology, we'll also look at that. Tokenized private credit is relatively new. So in context, the world of that 2 trillion private credit market, we're seeing that there's just about 10 billion of tokenized private credit. So it's really small, relatively, but quite big in the context of most lending. And this came out of nowhere. Forgive the small chart, but essentially this didn't exist a couple of years ago. And a lot of the tokenization theme, this real-world asset theme, the biggest asset class that's gone on-chain as a real-world asset is private credit. So why is that happening, and why is Greengage looking to consider this opportunity? To get here first, I have to give thanks to stablecoins. If we didn't have them as an unlock, this wouldn't be possible. So we had to have the first killer app of stablecoins happen for real-world businesses to be able to get accustomed to working with the digital world. So obviously, stablecoins have a great use case for moving money cross-border faster than we can with traditional banking. But they also then acclimatize a business to thinking not just in terms of a bank account or an IBAN, but also in terms of a wallet. So they have then this digital address that behaves a lot like a bank account, but isn't a bank account. The savings that we've seen in private credit by tokenization are essentially in two buckets. So the first bucket is the middle and back office savings you can achieve by digitizing the debt. So we think of here the frictional costs. For example, if you're waiting for an escrow, or if you have a need to wait for those funds to send. If you digitize a loan, and here we've done a pilot really just to test this process with live money, you have in two wallets from the borrower and the lender the capacity to atomically settle a transaction, meaning that if you have a legal agreement, which these all will have, as loans are necessarily requiring a lender and a borrower to still engage in a legal contract, that legal contract, as soon as you sign the DocuSign, can kick off the conditions precedent for an atomic settlement of the transfer of funds, provided both sides have a wallet address. And here we had both sides on Coinbase Prime, which is the institutional solution that Coinbase offers its wholesale clients. And this was a very interesting way just to prove that we can get those savings in the middle and back office. The bigger saving here, and for me it's the one that I think we are really trying to push into, is this private credit market has a lot of intransparency. So it's a bit opaque, it's a bit of a black box as to what happens in the private credit world, because it's not public. This is done, it's in the name in the private space. And if we create what Greengage is looking to do, a bit of an Amazon for private credit, where we can post the underlying opportunities for our clients to see, both on the borrow and the lending side, what is available for them. By having that data hashed into a smart contract, it's inherently more discoverable than a private credit loan in the traditional way. And if that data is more discoverable, you get a little bit more competition on the pricing, meaning that the origination or the interest rate fees, our thesis is that they decrease. And if we can lower that cost of lending, we're targeting a 1% saving on the cost of private credit, meaning that we release the monies more for perhaps additional lending, but ultimately back to the business so that they can do more growth. So this is kind of why we're so interested in adding this swim lane to our credit platform. How this works in practice, I'm happy to drill into, but I don't want to belabor the point. This isn't just the only bit we're doing though, and this is where we're kind of building a bit what we call a smart data room. But there's a whole world of embedded finance or open finance, where we have lots of innovation happening with different credit providers in the fintech space. And our view here is that these are amazing things, but it's often difficult for an SME to navigate the available options that are in their purview. So if we think of ourselves as a Sherpa almost, we can curate these balance sheet options, plug them into what we call a smart data room. And if one of our clients is looking for a loan, the idea is we activate the visibility for them to see that they might have an invoice financing option. If they have an invoice that's good, maybe there's an R&D option for them to get a loan against a tax credit. And we can then just plug and play different choices. This is very much a work in progress, but this is where we're moving as a future for our business. And tokenization and DeFi are additional lanes for us to push or pull credit opportunities for our clients. The SME pain points we address, I think, and not too dissimilarly from the credit issues, are that it often takes a lot of time to open an account. Our idea is if we get the swim lane active in the right way, we can decrease that time for opening an account. Very few providers, as I mentioned, are crypto friendly, and quite a few of them are very expensive. So because we're a very thin tech stack and we're a small team, our view is that we can get these fees down and get the time down if we just find a better way of matching it. Very simply, it's an introducing platform that we're building, but we're doing this in a way that's open to DeFi. Why I think we're interesting is we've proven we can originate. We have our own tech stack. The smart data room, which is work in progress, we're also looking to integrate some AI to get more data sets from the SME loans interrogatable in a way, in a term sheet that's intelligible to third-party underwriters. And we've also established ourselves as some industry players. We're still a small firm though, so I'm not going to say we're killing it, but we're doing some interesting things that at least get some good attention in the press. Where we position ourselves is very different to the traditional banks, but we're also different to the challenger banks. And we're not regulated, as I said. So what we're trying to do is just open up something that is a bit hybrid between the tied agent banking model and the new world of challenger banks. I'm the founder of the business. I have a good team. We're just doing a funding round, but we're looking for a chief revenue officer, chief commercial officer in the time to come. We have some really interesting investors. Our biggest investor is Rootstock, which is a layer 2 on Bitcoin, so building smart contracts on Bitcoin. We also have Coincillion, which is a listed venture builder on Actis, one of the smaller UK exchanges. And then some key individuals from Coinbase, Matt Woods, which is an IFA, one of the, and one or two family offices. So what we're trying to do next is engage. We've been in the press a bit recently thanks to this Coinbase transaction, but we'd love to get to meet more SMEs, perhaps those that are struggling with banking or otherwise, and looking for interesting sources of credit. This is very much a whistle-stop tour into who we are, and so I don't want to speak too much, but I'd be very keen for questions, and of course happy to connect on LinkedIn or otherwise with our team. But I'll stop with there and drop the slides if I may.
Amazing, thank you. Any questions? Please come forward.
Hi, just trying to understand your business model and that 1% that you mentioned. Is it the 1% that you tap into that's like your potential of earning from the older transactions, or I didn't quite understand the point?
Yeah, it's a bit both. So we see that we can achieve a saving of 1%, but our fees roughly are also 1%, interestingly. So on average, we are taking about 1% as an origination fee for matching a borrower and lender. That's actually pretty competitive. In the Middle East, this on average is 2%. In the UK, it's a bit of a more competitive market, so it's probably closer to 1%. But people are very happy to pay for high quality origination. We always try to focus on that. For example, with crypto-backed lending, if we're able to find someone who's long in Bitcoin and is of a good kind of KYC background, people will gladly pay us on the other side of the trade for finding those clients. We try to build relationships with a view that we can matchmake intelligently. But that cost saving that we're aiming to achieve is also trying to sharpen the pencil with the overall cost of interest by getting more eyeballs. We do this, there's something it's an interesting concept, but a Dutch blind auction, meaning that you don't necessarily need to know what other people are competing or paying trying to get that piece of credit, but ultimately whomever settles, and this is like an eBay almost, but if you have competition for somebody who wants to give you that piece of loan, if people see more and there's more engagement, that's when we get that saving, but we're still trying to secure our 1% fee. If that decreases for our Greengage as a business model in the future, I would be only too happy because it means we've succeeded in getting more traction as a platform.
Amazing. And that Coinbase project that you are doing called Diamond, it's quite an interesting project. So you're working basically with people on Coinbase to maybe do some funding for some SMEs. Is that what the project is about? And
yeah, so Coinbase is obviously independent to Greengage, where we've been keen to kind of work with them because they're one of the best names in our industry. The reason we like them a lot bizarrely is because we can sue them. So if the tokenization goes wrong, there's a counterparty that's big enough and is a listed company that it de-risks the counterparty risk for a small business to engage in this kind of stuff. We're also mindful that a lot of the existing tokenized private credit, which is that 10 billion I mentioned, and there's names like Maple and Centrifuge, these are interesting businesses and they've proven that the technology works. But a lot of the businesses that post opportunities on these platforms are what we would call as subprime credit. So they're higher credit risk. And the reason that they're higher credit risk potentially is a lot of the providers that are giving them money to get loans are coming from the crypto native world. So as you know from the crypto world, you can get really high rates of return. If you're putting this into the real world asset thing, you're looking for those high rates of return. You're looking for something that's approximating what you would get and I'm not going to say meme coins are in any way commensurate with SME credit, but you might be willing to take a little bit more risk. Um, the Coinbase piece is for us an attempt to go down the credit stack and maybe go closer to prime. So the average interest rates, instead of being perhaps borrowing of 15, 20% for a business, we're aiming more for that 8 to 12%, which is not overly aggressive, but it is a higher quality of perhaps over collateralized lending. So invoice lending is kind of a closer proxy. The diamond technology itself is agnostic. Again, it's not necessarily driven by what my use case is, which is tokenizing SME credit. They're doing some really interesting projects around, for example, space rights. So you can tokenize from the satellite world of telephony a certain portion of the data that a certain space, like say one of these satellite companies, and that marketplace type activity needs a really clean and tech first back end for people to get cheap transaction and settlement. So if we make a proxy to the traditional capital markets, say stock exchanges, there's something called delivery versus payment. So you need to have somebody in the middle who's giving that trust to connect the two sides. In the digital world, you don't need the trust. It's the beauty of the blockchain because you know exactly what your counterparty has. You can see their wallet, you can see if they're pre-funded, if they're not. And if you build an infrastructure on top of that, you can reduce a lot of the counterparty credit risk. You can move a lot more quickly. And then some of these things, like what we're doing, you can bring the cost down that you can build really interesting things on top. Again, we're fairly early into this game, so we're doing a bit of crystal ball here. But there are some proven use cases that Diamond is just an example of one of these tokenization platforms. Securitize in the US is another, or the native blockchains themselves. They're all looking at real world assets as a theme.
Yeah. And you also mentioned that you work with these like APIs for different platforms and specifically AI as well. And I'm curious to find out what's your AI integration goals are like for the company.
So again, this is early days. We see the large language model space as something we can't compete in. So I think everybody's looking at agentic AI as how they can make a differentiation on top of the open AIs of the world. For us, the key thing that we can use AI for, I think, is that underwriting piece, or pre-underwriting, we call it. So if a company is looking for a loan, there's a lot of manpower to decipher that information and collate it into something that's intelligible for a third-party underwriter. And that's what our smart data room is looking to kind of refine. So if we take business A, who's got what we split into static and dynamic data, and we can load that into an AI agent that can systematize that into something that can approximate a term sheet, that then is very helpful for an underwriter to get something that matches their particular requirements. So we're looking to, again, match make using AI to distill that data into something that can be understood by a third party. You still need people, and here we talk about the, we call this an Iron Man approach. So we think humans are definitely going to need to be there to take risks, to get their heads around things, but tech can start to reduce the friction for an individual person to get the data that they need to make a good decision. That's kind of, I hope that answers your question.
Yes, thanks so much, and thank you for your presentation.
Thank you very much.
Any more questions?
Someone is asking, who are you trying to recruit? Can you just tell the role again, type of role?
Yeah, so we're just doing our Series A funding round, which will open up some sales positions for us. We're looking to scale, and the big one I'm looking to fill is the Chief Commercial Officer, Chief Revenue Officer, because I have to give my own weaknesses kind of a recognition. The person that we're really keen to get is somebody who's a deep drive into the credit space, because that's the big opportunity we've landed. And so I want somebody who has an underwriting background. I come from a banking background, but I'm not a deep underwriter. So I need somebody who can speak to clients, originate, And ideally, because we now have this Abu Dhabi office, in addition to the UK, have somebody that can play into those two worlds. But otherwise, we'd be looking for relationship managers, an additional tech team as we scale our smart data room.
Any more questions? Can you go forward?
Okay, someone's coming forward to ask a question.
Oh, cool.
Hi. So, in a traditional context, you will have someone, because they are regulated, calculating expected, unexpected loss, talking about the credit risk, and then putting aside provisions, capital, calculating whether we are within risk appetite and the likes. Well, you are basically the middleman, so someone who has the Bitcoin will pass over the funds for the business, the other business, to buy whatever. So who's assuming the credit risk?
Yeah.
Do these people who lend the funds are fully aware of that? Are they, say, informed investors, or if you can elaborate on that?
Yeah, so we're small right now, so we don't take any credit risk ourselves. We're just acting as a platform to introduce borrowers and lenders. The lenders are taking the full credit risk. So in this case, we're plugging into, when I say family offices or credit funds, these are the big boys. We can call them the money bags. They've got cash, they give loans, they assess a business, or they assess the credit risk. Crypto lending is just where we've really started to hit our sweet spot, but it's, again, one of the many types of things we're looking at. We've got a very interesting partner who's a UK-based individual, and he's lending essentially to wealthy people payday loans, as an example. So if you've got a big estate, or you've got a lot of assets that are short in cash, this is one of the types of things that banks have pulled away from doing. For whatever reason, it's maybe too much headache for them to look at a bespoke case. So interesting balance sheets have started to grow. I call these the gems, that for us to build any platform business, we have to find people that are on both sides of the transaction. And for where we are now, we're hunting for interesting partners who have maybe different approaches to offering credit. And there's lots of interesting innovation in this space. There's people that lend, when I say against invoices, you can lend against, for software as a service businesses, future revenue streams. You can look at different ways of cutting intellectual property. You can lend against someone's patent. You can lend against somebody's shares. Unlisted shares or listed shares have different loan rates. And so when I say swim lanes, we're just acting to, it's as a broker essentially, but in the B2B space, and connect dots where that makes sense. As we grow the business, one of the real issues that's a problem in particularly the SME lending space is credit ratings. So you hit the nail on the head. There's risk that happens here. How do you get that risk to be understood by the lenders that might engage? And when I want to get more eyeballs on a particular loan to sharpen the price, right now the likes of S&P and Moody's and the big credit ratings agencies, they don't do SME. They do the big boys. They go to the listed capital markets or the larger firms. And so one thing that we're having to look at, and again, there's a lot of innovation here, particularly in the tokenized private credit space or crypto-backed lending space, is how do you get some kind of credit rating coming online so that you can give comfort to a lender that you're not going to trust this outright, but it gives you something to steer the allocation of capital. And I'd love for Greengage to be a part of that credit piece as well. But we're too small right now, maybe post our Series A. And what we could do is, say there's a demand for 10 million, make it a nice round figure from a client. If we put some chips on the table as a house, say we've got enough data and we've got a little bit of a credit fund of our own or a partner we can work with, maybe we put in 200K of that ourselves, we put our chips on the table, we put our neck on the line. And that could give comfort potentially to a third-party lender to come online and participate. But we're not going to take the full credit risk, and I don't want to, because we're building a platform business that connects dots. I don't want us to recreate a tied agent banking model. That's kind of for me where my own journey has taken me away from that approach. Yeah.
Amazing. Well, thank you so much for your excellent presentation, for answering the questions. Thank you so much.
Pleasure. Have a good evening. Sorry, I hope to see Scotland soon enough.
See you. Bye.
Bye. Bye.